Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we have a lot to cover as markets resume what looks like a bit of a bullish trend here to see where markets stand and what our views are going forward. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off as we normally do with a broader market update just to see where the major indices currently sit. Most of them are making new all-time highs. A few are catching up, so we'll take a look at where they currently sit. And then we do want to give an update on the fixed income markets, as that's what's driven a lot of the volatility we've seen here over the past few weeks, where they currently stand, as well as some commodities where we see some catch-up potential here for some of the commodities. And then take a look at sector rotation data. Take a look at specific sectors, specific industries that are starting to see some outperformance, which ones are starting to pull back a little, so that you can get a sense for if you're playing for a breakout here, where you want to position within the sectors. Take a look at the economic data, how they currently stand, and share with you a few ideas before we open this up for Q&A at the very end. But the primary question that I want to help investors answer from today's session is really the question that we've been getting over the past couple of days. Are markets ready to resume another leg higher? We've had a lot of volatility here over the past month, and the question is, has that stabilized? Has that is this just a little bit of a bounce and we're going to see further downside? So I'm going to use my technical research, my charts, to help answer that question for investors. So when we look at the S&P 500, we had a double top form here from a couple of days ago, but yesterday, on yesterday's close, we broke out above that level. So this is the first indication that things are resuming a bullish trend, that after a pullback here down to the 370 level here, which has been a large support and resistance level, we managed to get all the way back to that level within just about a week's trading time, paused very quickly at that level, and now we've broken through. So that's our first evidence that markets are resuming a bullish trend. When we look at the QQQ, the NASDAQ 100 index, not as strong, pulled back 11% all the way down to the 298 level, which has been a major support and resistance level since the election. As you can see, this 298 level has provided a fair amount of selling and buying over a period of time, pulled back all the way to that level and bounced higher. Now, the key level that I'm paying attention to is that orange line, which is the 21-day moving average. It has provided resistance multiple times throughout this sell-off here, but yesterday's close, we broke back above that level. So from my perspective, this would certainly put the NASDAQ 100 back into, I would say, neutral territory for it to trigger and target that upside 338, 339 all-time high. And if we see this break that all-time high, then all markets turn bullish here. But right now, the S&P 500 leading the technology NASDAQ 100 index. But if we look across the board, if we look at just the S&P and NASDAQ, things look okay. But when we look at other markets like IWM, small caps, breaking out to new all-time highs after that pullback here, quickly got back to its all-time high, broke out higher. So when you look at this on balance, the S&P 500 breaking to new all-time highs, that's bullish. The small cap Russell 2000 breaking to new all-time highs, that's bullish. You have the same thing in the Dow, and you also have this in the RSP, which is the S&P 500 equal weight index, and the equal weight index actually outperforming the market cap index. You don't see that very often, but when you do, that's usually a good sign that you have broad support for this market rally here. It's not just a few big tech names dragging the markets higher. You have actually more of the S&P 500 names rallying than just the top few sectors, the top few tech names. So this is, at least from my perspective, looking quite bullish when we see broad-based rallies like we've seen here in RSP, especially when it's coincided or confirmed by the Russell 2000 and the S&P 500, and it's just the NASDAQ 100 index right now playing a little bit of catch up here. So that's this. So the NASDAQ 100 index certainly has some room to get to the upside, but broadly all indices looking fairly positive here. Now, the one thing I do want to pay attention to here is this value versus growth. We've seen value underperform growth for multiple years. We talked about this bottoming formation that has been put in place here over the past year or so, and we finally broke out above that I would say bottoming formation a few weeks ago. So this is a zoomed in version of that chart. You had that breakout, a bit of a pullback, and a quick move here to the upside over the past few weeks. Now this has started to moderate a little bit again. Now the question is whether this can break above this major resistance level. If it can break above that major resistance level, I would say that you have a nice resumption of this value play. Value still continues to outpace growth here. But if it fails and starts to turn back lower and gets back into this range here, then we certainly would say growth is back in play here. So the question really is, is value taking over? Is growth taking over? Growth has certainly taken a bit of a hit here over the past couple of weeks, but is that trend over? It's yet to be seen. We've only have about two and a half weeks worth of data here. So very early days, but this is one that I would pay attention to help us determine where do we focus, where do we place our bets on this upside here in equities. Now, a lot of the volatility we've seen over the past few weeks has been driven by this big increase we've seen in terms of 10-year yields, up from 120 basis points to about 160 basis points in the short span of a couple of weeks. And just to zoom out a little bit here on the weekly chart, as you can see, that's the breakout I'm talking about from 120 to 155. It's now broken back above that 155 level, but it's paused a little. We've seen some exhaustion here as rates continue to move to the upside, momentum no longer confirming those highs, suggesting that we're likely going to see more of some consolidation before perhaps continuing a resumption higher here. But at least during this consolidation phase, I think equity markets are likely going to continue moving higher here in this particular market environment. So that's where we currently see, treasury bonds. And the one thing that I did point out here last week is, some sector rotation that we continue to see is fairly healthy here. When you see rotation from the broader markets, so when we see that the NASDAQ 100 index that was leading the markets higher pull back, while now the S&P 500, the Russell, and the Dow Jones leading the markets higher, that type of sector rotation is healthy for a market rally. You don't want to just see one index continuing to outperform over and over and over, because that tells us that leadership is very narrow. But you want to see broad-based leadership, and that's exactly what we're seeing right now. So that's healthy for a market rally. And then when you look within equities, when you look at the sector rotations, you also want to see that it's not just one sector dominating the growth of equities. Now, I will say for about 5-6 weeks now, financials and energy were the top sectors. However, we've seen here over the past 10 trading days, financials and energy have actually pulled back substantially. They've actually come into the weakening phase. And what we're starting to see is some leadership out of utilities, out of consumer staples, even consumer discretionary coming up on that sector rotation model here, while industrials and materials, while still leading, is starting to slow down a little bit here. So this amount of healthy rotation, as you can see, also communications coming up a little higher, real estate coming a little higher. The only one that's kind of still weak here is technology. Perhaps we might see this shift a little bit here over the next few days. And healthcare. Healthcare remains kind of in this improving space. It's kind of this stealth rally that we keep seeing from healthcare. It hasn't managed to make much ground here, but it's one that we want to pay attention to. It's really, but I think the main ones that I'm paying attention to right now is staples, utilities, consumer discretionary, while keeping an eye out here on materials and industrials, as this is seemingly slowing down alongside financials and energy. So that's what we're currently seeing on the sector rotation side. And this is, again, when you see this amount of rotation, it is healthy for the market rally and provides confidence in the rally that we're starting to see here in equities, as some investors are concerned, as markets continue to push all-time highs, are these shorting opportunities, are these market tops that we're starting to see. Looking at the evidence of the rotation we're seeing from the broader markets and the evidence from the rotation we're seeing within the sectors, that does not seem to lead to be the conclusion that I would draw from the equity markets that we're currently in. Now, when we look over here to the fixed income side, as we saw the 10-year yield continue to climb, TLT continues to move to the downside, but there is slowing momentum here. As you can see, as TLT has made new lows over here over the past few weeks, momentum no longer confirming those lows, and also TLT getting to an extremely oversold level. So, and as you can see here on the TLT, the rally that we've seen here, this double top that formed here at 171, we've seen quite a bit of a pullback here to the 200-week moving average, and which also corresponds with a fib level here around 134. So we're just shy of that 134 level here. So I certainly think that we are near a bottom here on TLT and potentially a top for rates for now, and at least see a bit of a consolidation here on some of these treasury names like TLT. On the flip side, the one thing that was concerning to me was the fact that we saw investment grades sell off alongside TLT. Now, usually in a risk-on environment, meaning when investors have confidence in the markets, you see selling of treasuries, but then you usually see on the back end of that buying of investment grade, buying of high yield. And when you see investment grade and treasury sell off at the same time, that's usually not a very strong vote of confidence from fixed income investors. And the fixed income markets are much larger than in the equity markets. So that was a concerning sign to me, a concerning thing to pay attention to. But the one thing that I will say that alleviates some of that concern, at least in the short run, is the fact that HYG, which is high yield, so we're talking even riskier in terms of the risk spectrum than investment grade, high yield actually continues to outperform investment grade. So when high yield outperforms investment grade, this is a vote of confidence in terms of the risk on environment, because if investors are moving further out into the risk curve, going out to riskier fixed income products just to chase yield, that means that they are still to a large degree confident in the economic recovery. If they were less confident, if they were feeling that markets were near a top, you would see the opposite. You would see selling of high yield, buying of investment grade. So we're not seeing that just yet, but this is one that I really want to pay attention to because we are nearing some major resistance level here on this high yield versus LQD. If we start to see this reverse lower, if we start to see investment grade outperform high yield and it's selling off in conjunction with treasuries, that would be the signal that is concerning to me. We haven't seen that right now, but this is one that I think is very, very important to pay attention to. When we switch over here to commodities, gold continues to decline here to the downside, but it has reached a fairly oversold condition, as you can see on the daily RSI. The last time it got below this 20 level here, we had a very nice bounce. We got down to the 20 level here again, and the question is whether we're going to see a bit of a bounce here. Silver so far holding up much stronger here than gold, and gold getting back to what was a fairly strong support level here around 157 or so, which, as you can see on the weekly chart, has acted as a strong support and resistance level here. So if you miss this potential breakout here, we've gotten a slow grind here back to this level, and the question is whether this will bounce higher or break below. If it breaks below, this certainly puts gold, in my opinion, substantially lower here, back into the high 140s to the downside. So this is an important support level to pay attention to for gold and also for silver. So the question is whether gold's going to play a little bit of catch up here. You certainly have some resistance here around the 168 or so. I think that a bounce would likely get back up to that level, and if we can break back above that level, then it can get back into the 180s, potentially even 190s here to the upside. If we look over to crude here, and this is part of why we've seen XLE lose that momentum and lose that leadership here, it really comes down to the fact that as oil continues to time here over the past few weeks, we've seen this massive negative divergence and losing of momentum here for oil prices to the upside. You also have some major resistance levels here in the $64, $65 area for crude. So this is part of the I would say consolidation that we're likely going to see for crude pricing as well, which will likely bring the rally here in XLE to a bit of a pause, unless crude can continue to rally from these levels. But as of right now, it looks like crude pricing getting a little bit of exhaustion here, perhaps consolidating, maybe even pulling back a little from these levels. And then looking at the individual sectors, I think the one sector that I want to pay attention to is communications. Communications recently consolidating after a period of time. So during this volatility period, during this period where technology sold off fairly heavily, communications held in very well, playing quite a bit of defense here, and now providing leadership as things stabilize a little. XLC communications breaking out higher here. So names within the XLC space are ones that I would pay attention to. Everything from Dish Network to Disney. Those are some of the names that you might see some leadership here over the next couple of weeks as perhaps equities, as equities look a little bit more bullish as we break out to new all-time highs. Another one to pay attention to, this is one that during the volatility period, we said stay away, play a little bit more defensive. Now it's managed to pull back all the way to this major support level here around 106. This was the major level that it broke out from all the way up into that 160 zone and pulled back 100% of that move and is now retraced roughly 50%. Now it's back at that 21-day moving average. As you can see, that 21-day moving average providing quite a bit of resistance through the sell-off here. If it can break back above that level, I certainly think that you could see this back up to that 160 level. So this is one paying attention to here on a potential breakout above the 21-day moving average. And today looks like we might open just above that 21-day moving average. So looking for potentially an upside here on ARK, a very popular ETF for tech investors here today. Another one that we want to pay attention to is Jets. Jets managed to break out above this $27 level here. And this is an important level because for a long time before the pandemic, this ETF, which has a lot of global airlines in it, has been trading within this range between 27 and 32 or so. So there's a lot of supply here in here, but it managed to break into this range. So you might see a bit of a pullback here and then a continuation higher here back into this range. But we've broken out above this $27 resistance level, broken out higher on the TSA data here from yesterday. This is overbought, so be careful. I don't think this is one that you want to chase. As you can see, momentum is overbought here, and you see some negative divergence here. So I wouldn't chase this. I would wait for a bit of a pullback here, and I think you could see a pullback here over the next few days. Look for that opportunity. Be patient on some of these. We see a lot of sectors, a lot of names that have very similar price setup here, where you've broken out to a new all-time high, but as you can see, momentum not confirming that. It doesn't mean that it's not bullish. It just means that the timing on this is not particularly great to go long at the moment. Wait for a pullback here, then look for that long opportunity. So switching over a little bit to the economic side of things, looking at sentiment, we are starting to see some improvements here on sentiment, consumer sentiment, which has been moderating for quite a few months now as the virus has continued to be an issue, and the rollout of the vaccine has been somewhat rough at the beginning. Has really started to hit. We've really started to hit our stride here on the vaccine here in the U.S. So the survey was 78.5. We came in at 83. So surprising us to the upside on consumer sentiment, and also business surveys. The Evercore ISI company survey back to pre-pandemic levels here. So overall sentiment, both from a consumer perspective as well as from a business perspective, looking on the stronger side at the moment because, again, of the fairly strong news we've seen out of the vaccine rollouts here in the U.S. We have quite a few states already moving towards, allowing all residents to have access to the vaccine in early April. There's one state already, Alaska, that has already made it available to all residents. So, U.S. clearly the leader here, with the exception of just a few smaller countries around the world that has. But as a major developed country, the U.S. US is really far ahead of all of our other peers. And for those reasons, we're seeing that reflect in the consumer sentiment data. And business conditions continue to improve as well. Empire Manufacturing Index coming out higher than expected, 17.4 versus the expected of 15.0. And if you look at and the number of employees that businesses expect to bring on over the next 6 months, we're talking about decade highs. We're talking about pretty much decade highs that we haven't seen these types of levels. And that is the type of number that we need to see for the economic recovery to really catch up, if you will, to where the equity markets are currently trading. The equity markets have already priced much of this in, and we really need to see the data catch up with that in order for this equity market to sustain these types of rallies. So we're seeing some parts of this show up in the economic data, and things certainly have been improving here over the past few weeks as over the past few months, things have kind of moderated quite a bit and started to look like they were slowing down. We're now starting to see that economic data play a little bit of catch up now. So looking at some ideas, and this is really a mixture of ideas across, I would say, the risk spectrum. I know many investors want to get back into some of those technology stocks, especially for hoping that perhaps some of those technology stocks that perhaps you had purchased in January and February and you're underwater on them and you're trying to get back to break even. I think you want to take a more of a diversified approach here from the recovery perspective, because I do think, as you see on that sector rotation, technology is still in a lagging category. It could get back into that leadership category, but right now we're seeing a lot of other segments provide that leadership. Everything from utilities to consumer discretionary, consumer staples, and then out of financials, out of energy, at least in the short run, looking at some other opportunities here. So consumer discretionary, housing remains one of the strongest aspects of consumer discretionary. So looking at DR Horton, in my opinion, still out of the home builders, the strongest one, just on the verge of a breakout here above this base that had formed after consolidating for quite some time. You know, during this time, housing has been extremely strong. DR Horton, one of the strong contenders within the housing space, building that base above that $78 level, and I think about to break out here from this $84 level here, making a new all-time high. That would certainly put this in the leadership category from the home builders, and XLY, consumer discretionary, one of the leading sectors here at the moment. The other one I want to take a look at is really more of a reopening trade, and this is what we see across the board. We're seeing opportunities. We're seeing it in the airlines. We're seeing it in consumer discretionary, and you have this massive bottoming formation. So Carnival has been underperforming for multiple years before getting into the pandemic, fell apart during the pandemic, and has spent the last few months really building this, however you want to call this base, and over the past couple of weeks just broke out from that base. So after breaking out, it would have been easy to miss this breakout here. I think, because it happened in just a few days. You had that massive pullback here, and now we've broken above that base. So this certainly puts you in a better risk to reward category here to shoot for maybe this $40 support level that held before the pandemic. That's the upside we see here. It's currently trading at about $30. So we're talking about a 33% upside to that next resistance level here for a reopening trade like Carnival. And lastly, on the tech side, you want to look at some of the smaller names, in my opinion, for technology at the moment. I think Microsoft and Apple will not provide the leadership here at the moment. You have some names like Twitter that have taken a big hit, but have now resumed back above its 21-day moving average. That would be the signal for me to look for opportunities to get back in. Twitter currently trading at 70. That all-time high is around 80. I think it's reasonable to target that all-time high here to the upside in a name like like Twitter, or if you want to use a broad-based index like ARK that I was showing you here before. That's how I want to view opportunities here in the broader markets, looking for more established players, but on the smaller side that has a little bit of that momentum to move here to the upside, rather than the Apples and Microsofts of the world that did play a lot of defense over the past couple of weeks. But as we start to see a little bit more confidence in this equity rally, you can move a little further out into the risk spectrum, away from the more defensive tech names like Apple and Microsoft. So with that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding as to what we're currently seeing here in the broader markets and how I'm viewing this. So with that, I hope you guys have a great trading day, and I'll see you guys here actually later this afternoon on our options education webinar, where we're going to cover how to open and close positions and manage your orders, if you will, with Firstrade around your options education. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys this afternoon.